Howdy out there, folks. This is Darius Dale here, founder and CEO of 42 Macro. I'm joined with Leland Miller, founder and CEO of China Beige Book, one of the world's most brightest, most sharpest analysts in the world on China, all things China politics, China economics, China financial markets. So we're really blessed to have a wonderful guest today to bring a lot of insight and knowledge to you guys. How you doing today, Leland?
I'm doing well. Thanks, Darius.
Yeah, appreciate you, man. So before we even kind of get into China, what is China Beige Book for those of you, for those in the audience who sort of haven't heard of you or haven't heard of the firm?
Yeah, so this is my fourth real vision. So hopefully people are learning over time, but I like giving the summary. China Beige Book started over a decade ago for one simple purpose. We didn't think you can trust Chinese official statistics. We didn't think there was enough data on the economy, even for those that wanted to use official statistics. And we wanted to try to pinpoint what was going on in China beyond one or two or three numbers. People like to talk about the GDP growth. They cite the PMI. We thought this is a number that's supposed to represent China, but there's actually a lot of different Chinas. There's regional differences. There's sectoral differences. There's difference between state firms and private firms. There's difference between large firms and SMEs, and most of those divergences are lost when you start to look at the big headline numbers. So what we decided to do was start with something that would work from the ground up. And we survey, back then it was thousands of firms a year. Now it's tens of thousands of firms a year. Corporates across the Chinese economy, Chinese corporates, foreign corporates, state, private, large SME, micro firms across all the major sectors, 37 subsectors across every geographical region in China. And we try to track what's actually going on from the ground up and then tell the story. And, a lot of people like to focus on the growth numbers for obvious reasons, but what we try to do is not just track growth and corporate performance, but also track inflation and also track the labor market, because there's almost nothing out there tracking China's labor market, which is notoriously bad statistics, and probably most important, the credit market. And we track credit and shadow finance. And other than the PBOC, I think we're the only people in the world who track what's happening in China's shadow finance universe. So we know, for instance, what a Beijing retailer is paying for capital in the traditional banking system versus a Chongqing retailer versus a Tibetan miner in the shadow finance system. And that is often the most important lens to watch China, not just looking at where growth is, because the Chinese government has always targeted growth and met their growth numbers. So it didn't tell you that much at any given time. But credit tells a story. Some of these other data tell a story. The differences within China tell a story, and that's what we do. We're the largest private data collection operation in the world inside the Chinese economy.
That's wonderful, man. You said something several times that really resonated with me. You said the phrase "tell a story." And I know you get a lot of sort of pressure from, guys like myself, investors say, hey, what's the headline? What's the takeaway? How can I take this and go make money with that? But, I think this interview, we want to both do that, but also kind of unpack a lot of things, because there's a lot going on in China right now, particularly from a policy perspective, that I think a lot of us in the West are missing. You've been very vocal about this in terms of, the terminal rate, the destination with respect to the terminal rate of the Chinese growth is just much lower than I think a lot of us understand. Walk us through some of the data that you're looking at that would suggest that, both on the sort of econometric front, but also with respect to policy.
Sure. So you said you talk about a story. I'll tell a story that I think illustrates this through the lens of our data. When we saw China emerge from the partial lockdowns during its initial COVID recovery, we saw the same thing in our data that official data showed, which was the recovery was overwhelmingly driven by industry. Manufacturing was doing well, commodities was doing well, property was doing well, retail and services, not so much. And the belief as we went along, now keep in mind too, that the intensity of the recovery, the Chinese said there was year-on-year growth within weeks. That was ludicrous. Of course, there wasn't year-on-year GDP growth. We actually track, how many of the workforces were back, what capacity factories and other companies were operating at. You had 20, 30, 40% capacity at some of these firms, and they were reporting, over 100% implying over 100%, output and production levels from a year before. So there's no question the Chinese, for political reasons, pulled the growth forward, want to announce a nice GDP number right off the bat. But directionally, we saw the same story as they did at the beginning, which is industry-led recovery. Now, here's where it gets a little bit dicey for markets, because the widespread assumption, I think this is nearly universal, as we got into 2021, was that you were going to see a retail bounce back, a return of the Chinese consumer. And it made sense from a thesis standpoint, because you had a recovery and it looked pretty good. And if it was normalizing, then you'd have the consumer return and sort of have a more balanced economy as you return to normal. We knew this was never going to happen at China Beige Book, because when we looked at our data, we saw some of the worst retail data we've seen in the history of the survey, dating back 10 years. So not only were the headline metrics in retail terrible, not just profits and revenue and cash flow and other things looking bad, but hiring was slowing, investment was slowing, and we saw the lowest level of retail borrowing in a decade in retail. Wow. So the idea that this was the sector that was poised to bounce back and the Chinese consumer was going to surprise us to the upside in the second half of 2021, that was never going to happen. People believed it did. They wanted it to happen. It was never going to happen. When it didn't happen, people were shocked, and consensus on China completely flipped in 2021. And that was aided, of course, by the fact that Xi had started his policy crackdowns, and there was an RR cut over the summer, which made it look like policymakers were on the defensive. And so people were very nervous about China. They went from saying, wow, look at this incredible recovery, great things ahead, which was never realistic, to thinking, oh no, the economy's falling apart. And of course, when you see China's economy look weak, you see data look weak, what are China watchers, what have they been trained to do for 2 decades? Predict stimulus. Totally. So everyone predicted, hey, there's a big wave of stimulus. We're going to see big time policy easing. You had the investment banks saying 1, 2, maybe 3 RRR cuts. That's coming next. We looked at our data and said, no, this isn't right either. Because when we look at what's happening in the credit data, things were tight and potentially getting even tighter. You saw borrowing tighter than, continuing to get tight throughout the year. A lot of people compare the deleveraging with quotes. I'm using air quotes with deleveraging that happened in 2021 with the deleveraging campaign of 2016 to 2018. Back then, there was no deleveraging. There was a shadow bank crackdown, and they made state firms borrow less for a stint, but there was absolutely no deleveraging. When we got to 2021, it was fascinating because we had never seen data on the China Beige Book platform go downward slope across every cohort. So every sector was borrowing less. Every region was borrowing less. Every size firm was borrowing less. And it kept going month after month, quarter after quarter. So the idea that they were gearing up for this big stimulus was also made no sense. But then here's what really threw people off. And here's the end of the story. People pour their hair out because they're like, we didn't get our consumer bounce back. But then all the stimulus we've been predicting, it must be coming. It didn't come. What is happening? Everything we've been taught for the last 20 years doesn't make sense. Well, that's because the Chinese growth model has changed. They're at the end of the road on the Chinese growth model, and policy making has changed to accept slower, hopefully healthier growth going forward. And I think that markets aren't properly prepared. Investors aren't properly prepared for the degree of a slowdown we're going to see going forward, with, of course, 2022, a political year, being the exception.
Yeah, no, I think it's one metric I like to track is 3-month SHIBOR, not to make it too simplistic, but as you know better than anyone that, the balance of Chinese credit, most of Chinese credit, 83% in particular, if you look at the BIS data, is on bank balance sheets. So you can get a good sense of the full range of PBOC's easing initiatives or tightening initiatives by looking at that. And historically, going back to the comment you made about Western investors being trained effectively to anticipate major policy easing and initiatives whenever Chinese growth slow down, whenever there's a credit slowdown in terms of the credit impulse. You've seen that. Shibor, 3-month Shibor, for instance, is typically decline anywhere from 200 to 300 basis points, and you've seen these massive, ferocious rebounds. This happened 4 times in the last sort of 10 to 12 years. We've got none of that. I mean, 3-month Shibor is actually up on a 6-month, 9-month basis. And so clearly, not only are the triple R cuts that we've seen, we got one in June or July, and then we obviously got one a couple weeks ago. They're clearly not taking in the same way that we've historically seen that. And clearly the space between them and the size of the cut in these easing programs are very different than anything we've seen in China. And we're talking about the lowest rate of Chinese credit growth. You look at total loans of financial institutions, they're somewhere around 11.7%. It's the lowest growth rate we've seen since 2002. And so there's clearly not a panic in Beijing to sort of arrest this growth slowdown. So it really lends credence to a lot of what you're saying with respect to their changed initiative, their changed focus.
Well, that's a very key point, because if you read headlines or you read financial media in general right now, you would think that Beijing is in panic mode, first about the property sector, but then also about recent retail data. And you read about, this is a cataclysm. This is terrible. Look, the economy's slowing. It's not in a great place right now. But the pessimism, I think, is too high for a bunch of reasons. But what Beijing's really worried about next year, and this is sort of a separate topic, is the Fed constraining their policy options, when they need to use credit because they think they need to use credit. But when we look into 2022, the conditions will ease. We already have seen conditions ease in China Beige book data to some degree, particularly in property. So they're letting off some steam. That does not mean a return to the status quo ante. That does not mean they're giving up or they're panicking or anything else. It just means that 2022 is going to be a better year than 2021, because 2021 was full of remarkable tightening, and 2022 is a political year. Yes, you've got the Olympics, but more importantly, you've got the Party Congress next fall, where Xi will be recoronated for either his 3rd term or the beginning of his lifetime tenure, or whatever they decide to actually term it. It's a hugely politically sensitive year. And so there will be loosening of controls. There will be easing of conditions. But I think the problem with most analysis right now is that people raise their hand. They say, hey, we're going to see policy easing in 2022. That's my forecast. Well, that's a useless forecast, because everybody knows that. There is no chance you will not see directionally more policy easing in 2022 than 2021. You have to be able to understand what type of policy easing. Are we going back to 2017? The answer is no. Are we having a much milder type of reaction to sort of create upbeat sentiment, maybe feed some of this property money ball, feed it into the equities, into the stock market? Maybe so, but it's a very different dynamic. So it's important for people to understand that just having an easing call for 2022, that is a substantively useless statement. You have to understand what this credit, what the credit environment is going to look like in 2022. That's the key to understanding where they're going with this with this policy.
Yeah, no, you brought up something that was super important to me. Something I learned from your colleague Derek Scissors quite a few years ago, which was the stimulus that they sort of launched in 2015, 2016. A lot of us on Wall Street have termed that the Shanghai Accord, in terms of how big it was. I mean, in terms of our analysis of the impulse from the fiscal and monetary authorities in China at that time, it was sort of on. It wasn't quite as big as 2008, 2009, but it was on par. In terms of how big that easing initiative was. And the one thing I learned from Derek was that she wasn't really too happy about that. He wasn't very thrilled about that. That was sort of, I'm blanking on the gentleman's name, but who sort of orchestrated that. But that was kind of the last gasp effort, or really the final kind of straw, if you will, as it relates to the old model for growth. Hey, let's just go and reinflate secondary industries and create jobs that way. We're very clearly in a new paradigm with respect to China. So to your point on, okay, you expect easing in 2022, it ain't going to be like 2016, 2017. It ain't going to be like, 2008, 2009 and the easing initiatives between them. So sort of walk us through in terms of, what should we expect next year from China? Because obviously there's a huge calendar catalyst. You got the Olympics, the Party Congress. You have, you kind of made a joke about it. I think it's funny as well. What is G now? I'm actually kind of joking, but I'm half serious.
Well, look, he is general secretary for life, whether he announces that as his new position, whether he's chairman for life, whether he, announces another 5 or 10 years and then says, we'll wait and see, whether he appoints successors. Nobody knows. Nobody has a clue to how they're going to handle this. But it is a politically important year. There is no chance that the party will allow for sweeping negative sentiment to engulf the second half of the year. So what we do know is they're going to do enough to make sure that the job market is stable and secure, that sentiment is up, which probably means juicing stocks. It will mean making sure the economic data doesn't miss in a big way. So it's, I think the expectations, people right now want to hear some sort of, things are going to be really bad, or things are going to be really good. No, I think what they want to do is they want to improve sentiment, but they don't want to overdo it. And if they can avoid a problem, with the Fed hiking while they're talking about easing, if they can avoid a problem with the property sector deteriorating more than they want, then I think that'll make them happy. They don't need a surging economy. What they need is an improving economy, and this goes along with Xi's theme that common prosperity is hand in hand with slower, healthier growth. Because what you're essentially saying is, under common prosperity, the social compact is changing. And social compact for decades was, we will deliver high levels of growth and we will make you rich. And the party can't deliver that anymore. And so one of the reasons you're seeing common prosperity is because there's this idea that, we're going to embrace slower, healthier growth, and we're going to distribute the wealth more broadly. We're going to move to China's next stage of evolution. And so the economics around this are very closely tied to the politics and the social optics, because when you look at what they're cracking down on, big tech giants, billionaire moguls, Macau and rich gamblers, what they're trying to do is say, this is a China that's going to be geared towards the Chinese people, not towards rich capitalists. And so it's very easy to see the interwoven nature, the intersection of the politics and the economics in terms of growth drivers going forward and policy drivers going forward.
It's so interesting because on one hand, you say this sort of the Western investors are expecting this sort of big bear move or big bull move, and you're sort of saying it's kind of somewhere in between, but the direction of travel will be up with respect to growth, and up in sort of more with respect to sort of credit easing. Can they do that while also maintaining macroprudential tightening in the property sector? I mean, we all have this belief that, I think there's a lot of us or at least most of us on Wall Street or on global Wall Street have the belief that there's this sort of, the puppet master, Beijing, that has, its hands on everything, and it can, kind of tinker with these dials. It's almost like the man behind the curtain in The Wizard of Oz. Do they have that kind of control? And is there a risk of this sort of getting out of hand and them going too far, too soon, too fast?
They think they do. Look, of course, that's the risk. The risk when you're taking the second largest economy in the world and you're trying to tinker, and when you tinker, you're going to break something. But that said, people need to understand that when I'm talking about a long-term slowdown, when we're talking about the Chinese economy relinquishing property as this, mega growth driver, it doesn't mean they're just going to tighten until, everybody who's in bad shape dies. They're going to cull the herd. Then they're going to release the pressure a little bit. They're in a pressure releasing zone right now and into 2022. So they're going to make sure that the difficulties of certain firms don't domino down the line to other suppliers. So they're having all kinds of interesting financial gimmicks in order to do this. Sometimes the party orders people to take over, other firms to take over the liabilities of companies like Evergrande. Sometimes it allows, securitization of supply chain receivables, and new financial techniques to aid this. Sometimes it eases credit. But there will be a loosening of the crackdown as these firms sort of, solidify themselves. And then after a time, there will be a continued culling of the herd. So they expect to do this over time, but it's a mistake to think that anything is linear. And it actually fits in well for them for 2022 to be part of this sort of, I won't call it a roller coaster because the ups shouldn't be as high as the downs are low, but you see this sort of an upcycle in terms of allowing some oxygen to the sector, and then before they continue going down. So I think they can manage this big picture. But what does this suggest? This suggests that no matter how smart they are, even if these guys are economic magicians in Beijing, and they're not, but even if they were, you're going to have these economic dislocations from restructuring the economy, from de-risking the financial sector, from de-risking property, to trying to structurally improve consumption. If they do that, you're going to have things break. And you're going to create volatility. And that's why the likelihood is that you have some sort of China markets panic every 18 to 24 months going forward. And the reason I say that is not because things are going to disintegrate every 18 months to 24 months, but things are going to look scary at different times. And because people have no optics into China other than a handful of things like official data, well, China Beige book data, but very, very few lenses into China, if they see something scary, whether or not it's real, capital is going to start flowing out. You saw that in 2015. What happened in 2015 was mostly not real. What happened in 2016, early 2016, was real, but it's the same dynamic because investors don't trust the data and they don't trust Beijing to tell the truth on weakness. If they see things they don't like, if they say numbers they don't like, if they see stock markets fall or signals that there could be a currency devaluation, all the things we saw in 2015, you're going to see an outflow of capital. And that's going to cause systemic instability, even if nothing is really going on. And the funny thing about August 2015 is that nothing was really going on in the economy, but because the stock market fell, you had a bad PMI reading, and you had what people thought was the beginning of a currency devaluation, capital flew out. So sometimes the panics are real. Sometimes the panics are simply perceived. But I think as they do this restructuring, you're going to have a very tough time discerning between the two unless you've got really good information and data and insight into what's going on. And I think that's the future of China for the next 5, 10 plus years.
Yeah, I mean, imagine driving a car, texting, and talking to your grandmother at the same time. I mean, it's not like you can't get to your destination safely, but the probability of getting to your destination safely without an accident is much lower, right?
Something's going to happen. Something bad's going to happen along the way, and you just have to expect that and be able to react to it.
You have to expect that, and one thing that I think is bad that can happen, and it sort of goes back to the growth initiative, is there's estimates out there from Ken Rogoff at Harvard, and I forget the IMF economist Yuan Chen, I forget his name, but the property sector is somewhere around 30% of Chinese GDP. You guys might have different numbers on that. If you you're trying to do all this macroprudential, pervasive, sustained systemic macroprudential tightening in what is very clearly the largest sector of the economy, what do you replace it with? Where are you macroprudentially easing to offset that? And are they doing that? And kind of what's that process like?
Yeah, that is the key question for China going forward. When we were asked about Evergrande, and it was the crisis, was it going to be financial contagion? Was it going to spill over into global markets? Look, the Fed's wrong. Evergrande in and of itself is not a problem for the world. It's not a problem for world markets. The Chinese will handle it. They have all the tools in the world to contain this within the contain the fall in the property sector because they have a non-commercial financial system. And I beat this drum over and over and over because it's so important. China is not the United States. It's not Europe. It has a non-commercial financial system. And what that allows it to do is to swoosh capital across the financial system and plug holes and fix problems in a way that can't be done in a traditional system. So they have all the tools. They own or control the counterparties in the economy. So if Beijing wants to stop contagion, it tells suppliers to supply and borrowers to borrow and lenders to lend. And so the problem with Evergrande, or the problem with this property market distress, was never that it was going to, explode out of property and become a problem for the world or problem for the Chinese economy. The problem is that if you eliminate property as this sort of mega growth driver where you need some economic growth, you need some GDP growth, not productive growth necessarily, but GDP growth to hit your target at the end of the year. You turn on the spigots, you build a bunch more, you ease, and you create this reckless credit expansion of the sector. If you're taking that away, and I do think that they are taking that away going forward to the extent that they can, then you need to have a replacement for that growth, or your growth is going to drop precipitously. They do not now have a replacement. If you read or you listen to what they're saying, the implication is that somehow consumption, domestic consumption, will rise and fill the void that property once had. But that doesn't make a lot of sense. And the major reason it doesn't make sense is that they are not structurally doing any of the things they need to do in order to power the economy, in order to incentivize consumption. So investment's falling, sure enough, but consumption is not rising and consumption is not being empowered because structurally they're not helping that happen. If you want to empower consumers, you can put more purchasing power in their pockets through appreciating the currency in a big way. They're not doing that. They want a stable currency, even if you see some short-term appreciation. They're not transferring assets from the state sector to the household sector. And if anything, it's going the opposite direction. They're not materially enlarging the social safety net. They are on the margins, but what you're seeing is not the Chinese economic system shifting to a model that incentivizes consumption. You're either seeing a neutral stance or in some ways incentivizing the opposite, more centralization, more state control. So they can talk about rising consumption all they want, but what they're doing is not incentivizing it. And the biggest myth there ever was the idea that the Chinese consumer is rising. In our early data, the Chinese consumer wasn't rising. In our recent data, the Chinese consumer isn't rising. And there's no reason to think the Chinese consumer is going to rise in the future unless Beijing effectuates these policies, which will allow it to happen. So your question's a good one. They don't have an answer. And I think that's the real problem going forward. What will be the replacement? What's going to set the floor there?
Yeah, and I agree. And you listed off a lot of things that they could do, but can they do it? I mean, we talk about the social safety net, and I always thought that was sort of, kind of the one thing that was the one major thing that was really holding back Chinese consumption and keeping the savings rate elevated because of the lack of a social safety net provided by the government. Is that something they can do in the context of, heading into a multi-year cycle whereby capital flows are likely to be increasingly fickle? Where are they going to get the quote unquote the monies to finance an enlargement of the government sector or transfer of wealth from the public sector to the household sector? I mean, it seems like this is what they should do, but I guess can they actually do it in your opinion?
They can do it, but they won't do it because they don't want to give up the control. So the way that look, if they were to become more rule of law and to allow their private markets. Now, it could be too late considering how much decoupling is sort of slowly going on between the U.S. and Chinese economies. But if they wanted to just be a vacuum cleaner for global capital, even more so than they are now, all they have to do is ease the closed capital account, like allow capital to be more free, have clear rule of law provisions, open up their bond market. There's some things they could do, and the world would rush in because everyone wants yield, and the Chinese bond market could provide it. The Chinese economy could provide it. The problem is that you relinquish control, and everything that Xi is doing and looks like he's going to be doing going forward is based around the idea of securing more control over the economy, having more state control over assets, having more centralization, and the problem with that is, yes, it gives you the control in order to be able to more tightly push a program forward against vested interests. But what it doesn't allow you to do is move some of these pieces around in an advantageous way from a structural perspective. So it's possible, but they're not going to do it. And if they're not going to do it, then it begs the question, what's going to set a floor on growth? And I think this leads to the secondary conclusion, which means they can't simply make the property sector go away as a growth driver because they're going to have to hit certain levels of growth for their political narrative. Yes, it's going down. Yes, this political narrative will continue to talk about slower growth, but the GDP number going forward is going to be 100% political going
Oh,
forward.
yeah.
Now, you could argue it's always been a political number because they just juice things in order to hit it. But going forward, it's going to be completely political for really one simple reason. If they were doing these things to de-risk the economy, to de-risk the financial sector, to stop relying on reckless credit expansion, and to try to make the economy more productive, you'd be down to say 1 or 2% growth. They're not going to announce 1 or 2% growth. And so the question is a political question: how far above 1 or 2% growth can they go? Maybe it's 2 or 3% right now, and going down to 1 or 2% over the decade. But they're at a
Hmm.
much lower level of growth. So in order to hit the number that they think they need politically for their narrative, they're going to have to continue to juice things a bit. Less
Gotcha.
so, but a bit. And so this number's political because it's going to be based on what they think their political appetite is for announcing certain numbers and what jobs look like as they enter these numbers and release them to the world.
So let's unpack that a bit. You said something that sort of perked my ears up. You said that Chinese GDP, I guess, according to your data, would be running somewhere around 2 to 3%, which clearly is about half of what the government's officially reporting. And so, is that the correct sort of margin between your data and their data?
Well, not necessarily, because Chinese GDP is higher than that for the simple reason that when they have lower levels of growth, they just do enough to continue to keep growth higher. They funnel capital into non-productive uses in order to hit their targets. So Chinese GDP is higher than that most of the time. Sometimes a lot higher than that most of the time. But that doesn't mean that if they were doing this restructuring in a pure way going forward, it wouldn't be at 2 to 3%. Now, you may have other problems there, and you'd have a huge problem from a political standpoint. How do you say we've been growing at these high levels, and all of a sudden you're announcing 2 or 3 or 1? They're not going to do that. They're certainly not going to do that right off the bat. So the question is, how can they de-risk and slow everything down, but then still provide enough juice that they've got a plausible political narrative and that they're not shaking up the system to such a degree that it becomes a problem, first for party stability, but second for jobs. And of course, the two are closely connected. So they are going to have a political number going forward, a very completely political number going forward, which is why when I see these, investment bank forecasts, and they, like, they look down the road and they hear something bad and they move something down 1/10 of a percentage point, but everything's still basically a straight line. Not only are the numbers wrong, but the entire mode of thinking around Chinese growth going forward is wrong. These are not numbers they're going to hit. These are political numbers that they're going to have to juice to, and hopefully lower than higher, but it'll based on the situation on the ground. But they want to slow them down. They want to slow them down much more precipitously than people think.
Oh yeah, I'm very familiar with the Wall Street's modeling of the Chinese economy in 10 basis point increments. It makes no sense, but it is what
It's
it is.
nonsense.
It's a pastime.
Yeah.
Yeah.
I
In terms of
was out in Singapore for Bloomberg New Economy Forum last month, and a lot of great conversations. But I keep running into people who would pull me aside and say, "Look, you haven't been doing this as long as I have. They will be able to grow at 5 to 6% for the next 20 years." And I said, "All right, you can bring me out to lunch when that doesn't happen." Because it just, when you deal with people who've been doing this, IMF, World Bank, people who've been doing this, and this is their job, they've come to believe that the Chinese can just do whatever they say and that there's no end line to this. It's not true, but shaking people from this will take a jolt, and they haven't gotten the jolt yet.
It's interesting that you got that kind of pushback even in 2021. I mean, I did an analysis back in 2015. This was in early 2015 that sort of walked through the delta in Chinese credit creation historically, comparing them to historical credit creation, credit booms in years past. And the conclusion analysis, we should expect Chinese growth to decelerate 200 to 300 basis points per annum over the next 5 to 10 years. And that's exactly what's happened since then. We've seen a decent deceleration in the former pace of growth, coming from around 7-8% to now around kind of 5%, if you believe the numbers. And obviously you guys have different numbers. So it's interesting that there's still that school of thought out there that's sort of wed to this sort of backward looking view of growth at all costs, right? And very clearly we've transitioned from that, and I think a lot of Western investors have certainly kind of reevaluated the valuations and the multiples they assign to Chinese assets as a function of that, both as a function of the property sector contagion, but I think also as a function of starting to realize, I think at the margins, that hey, This is different. This is a very different. They're in a very, they're like an awkward teenage phase right now. We don't really know what the ultimate destination is, but it sounds like you guys have a really wonderful handle. In terms of having a wonderful handle, like where do you guys see the biggest divergences between sort of current growth inflation statistics relative to where you guys are, and particularly in the labor market and what that might mean heading into 2022?
Well, one thing that pops out would be inflation. This is amazing. I'm becoming a bull here on this call. The big fear in China was that at the beginning of the year in 2021, that China would have this major inflation problem. Beijing was worried about it. Markets were worried about it. And a lot of the commentary, a lot of the questions were asked is, will China export inflation to the world? No, they didn't. No, they won't. That's not how it works. However, there was a pretty intense commodities manufacturing property channel that was seeing some pretty high levels of inflation. That said, when you look at China Beige book growth, our input prices, sales prices, wage gains have been relatively moderate this entire year. We've seen spikes. And the closer you get to commodities and the closer you get to property and some other things, particularly early in the year, the higher you saw because of supply chain breakdowns and because of other global dynamics. But look, you saw some problems in there, but you saw a much more contained picture than people who were just staring at the Chinese CPI or the Chinese PPI and saying, well, whoa, look at these giant numbers. PPI in the double digits, you must have a problem here. We never saw an inflation problem in China in 2021. And since we're almost at the end, of 2021, I can say that it was, that was right. They had concerns, but they didn't have something that was spiraling out of control. And I think that never popped as being an issue for us. I think that when we go forward, it's not that we're seeing something different on the credit side. I think we're actually seeing similar, we're seeing an easing in the property sector. There's more bond issuance. There's more banks are opening up. In middle 2021, bank loan rejections shot through the roof in China Beige book data. People ask about what's the sign of distress? What's the signal of distress? It's not defaults. It's capital raising in a particular sector, and the property sector couldn't access bank credit. So loan rejections hit the highest level in the CBB history in the second and third quarter. And all these borrowers were being sent to the shadow finance system. They were paying more. They were under distress. And so we saw what was happening in property happen months and months before Evergrande sort of re-hit the headlines. But I think when you look at the property sector overall, it's not an issue of us seeing something different than maybe what markets are seeing. I think we're all seeing an easing of conditions. We're not seeing something so big yet, but we're seeing easing conditions. But the important thing here is that when you see larger numbers released officially, they don't always mean what you think they are. So if a TSF spikes, which it always does at the beginning of the year for structural reasons, everyone's like, oh, the Chinese are opening up the credit spigots. We're going to see growth. Well, look, what's more important, we track the supply side of credit, but we really focus on is the demand side of credit. So we track what firms are telling us in terms of loan demand, in terms of loan applications and rejections. What's pent-up demand? Are there firms, in other words, are there firms who want to borrow but aren't borrowing for a certain reason? When they are borrowing, are they doing it for cash flow reasons? Are they doing it for investment? What's the deal? We understand by tracking the demand side of credit things much, much better than people who are looking at it through the prism of TSF. Because what you see often, you saw this big time in 2016, which gave markets a big head fake back then. You saw a big TSF number. Everyone said, oh, well, growth's coming. You actually didn't go straight into that recovery that year. What happened was so much of that credit was being hoovered up by a VIP elite of large state firms. It wasn't being broadly distributed. Most firms still couldn't get capital. So that's sort of a long-winded way of saying that when you look at the credit numbers, big TSF numbers don't necessarily translate to broader borrowing, et cetera. You have to look at what firms themselves are telling you because they are talking about the dynamics in particular sectors and how broadly credit is available to those who actually want it.
Yeah, I say this all the time. And so, by the way, TSF, he's saying total social financing. That's the broadest measure of credit when you aggregate all the different components, ex-chattel financing, obviously. And so that, for those of you who don't know that, one thing I did, this will taking it back to something we discussed earlier. The reason I like to track the sort of the growth rate of total loans of financial institutions is, again, so much of the credit is on bank balance sheet. And so, we've seen many times in the last 4 or 5 years where, this big positive freak out, you get a big TSF number. It's like, oh yeah, China's easing. And it's like, no, growth's still slowing, and so this is there's some, obviously, a lot of political dynamics that could cause that.
And there's a reason for that, right? There's a reason for that.
Yeah, of course. Yeah. And so let's transition. As you know, we're all sort of investors here, and so let's kind of wrap up the conversation with kind of what do you think the kind of the best opportunities are? Because you and I are sort of in agreement. We're picking up on to obviously a far less extent that you guys do with your data, but we're picking up on a marginal shift towards easing. We're starting to hear talk of fiscal initiative, fiscal easing. I don't think it's going to be anything big. To your point in this conversation and to your broader points. We have a bullish bias on China already in terms of Chinese equities and see the Chinese economy bottoming in early Q1 and really kind of having not anything we're used to in terms of a recovery, but certainly something that's directionally positive and certainly a lot better than what we've seen throughout 2021. So does that make sense in terms of what your data is showing? And then two, what are your data sort of suggesting as the best sort of opportunities heading into next year?
Sure. So we're about a week-ish away from our getting our new Q4 data and putting that out. So that story still needs to be told a bit. What I can say is we spent a lot of time, and we spent a lot of time on our Twitter feed too at China Beige Book, not necessarily throwing out investment ideas, but popping holes in things we don't think make sense. So, one of the things that, we were very cautious about a number of months ago was people were saying, well, I think these tech crackdowns are done. I think, maybe Baba and Tencent and all these other companies are at these value levels. It looks like she's done. Well, look, it's very likely she was done. Now we know the last few weeks have been pretty terrible for the last few months have been pretty terrible for some of these companies. But I think that the idea here is we are in a run up to the Party Congress at the end of next year, not the end of 2021. So you have to be very cautious about making some of these bets because yes, you'll have improving sentiment, but it doesn't mean that they're not going to continue to crack down on some of these companies on the policy side. Are the coasts clear? The coasts are not clear. It doesn't mean that you can't be investing in these companies. Some very strategic investors are going to make a ton of money getting some of these internet giants and tech giants at these bargain basement rates. But you have to be very careful because the policy crackdown part of it is probably not over. It's certainly the run up to the Party Congress. It's fair game for there's something to be happening there. So to be very contained about looking at these things and just assuming, well, the Chinese economy is going to be better next year for Xi's coronation. So that means the policy crackdowns are over. The lesson may end up being the opposite. You got to be very careful about investing there. Secondly, like when you're looking at easing, very important for people who are talking about easing in 2022 to define the way we have in this conversation. What does easing mean? A 2017 style easing is not going to happen unless China goes into crisis because the Fed drives it over a cliff or something, which we don't expect. But unless you see China in crisis, you're going to see a very different stimulative atmosphere than I think people are projecting. Certainly in the headlines out there, but even in a lot of the analysis that we see. So, and I think the other thing that's important, and I was tweeting about this in the last couple of days. Am I urging people to rush into Chinese equities? No, look, that's not what we're trying to do. But what we're pointing out the last couple days, in particular, is that there are a lot of signals that as property is becoming scarier, maybe you should head over into the stock market over there. Hey, read through the lines. Look at what China's announcing. They're allowing, insurance companies to invest in the stock market. They're opening up the Stock Connect. They're incentivizing some other things. So a lot of the money ball in China, which can't escape China because you've got the closed capital account. It goes to whatever it sniffs out as being the favored sector that the government favors within their range of options. And if it's not going to property, it's not going to commodities or commodities futures, and bonds look a little bit icky right now, well, hey, maybe stocks are interesting. So, we're not coming out with this dogmatic call. I mean, JP Morgan came out and said, look, just close your eyes and put all your chips on the table for Chinese stocks next year. I don't think that's particularly thought out, even if it ends up being right. However, there are signals that they're going to want to juice some things, maybe the stock market along the way. And so it'll be a better year, but people shouldn't get too cocky.
Yeah, absolutely. One of the things I learned from Professor Roach at Yale is that, China was the powers that be in Beijing were aghast at how we allowed Lehman to fail. Like it just did not make any sense to them. Like this is, in their context, like what? Why would they let a major state, not a state bank, but a major player in their financial sector fail? And so I do believe there's this belief, personally, that there's this belief in Beijing that, hey, look, we're going to tinker, we're going to try to tinker, but they're obviously not going to let it get out of hand. And so, the reality is, in the context, is something we've talked about for many years, is, it's like playing a game of checkers, or not even checkers. I'm not sure what the appropriate analogy would be, but it's like, all right, well, we can't invest in stocks. Go invest in real estate. No real estate. Go buy gold. Go buy bonds. All right, go wealth management products. And so it's like a game of hot potato in terms of asset allocation in China and on Chinese household balance sheets. And so we do believe the kind of asset allocation game. If you think about, I've seen estimates as high as upwards of 20% of Chinese property is speculative, just purely speculative investment. And it could be even higher number than that. I'm not sure if you guys have figures on that, but if that number is true, then we know there needs to be a lot more deflating in terms of real estate prices. You look at price growth in second and third tier cities are back to levels that we've seen in 2016. First tier cities are not far behind in terms of the slowdown. And so as we continue to see more disinflation in the property sector, we're more likely and more increasingly likely to see inflation in the stock market, because guess what? There's nowhere else to go. There's nowhere for the money to go. Right. So in terms of, I guess this is the time of year for making bold predictions. But, one thing I checked before we started talking was, that since the beginning of 2020, so let's call Jan 20, the beginning of the pandemic, for all intents and purposes, since the beginning of 2020, the S&P 500 is up 45%. The Shanghai Composite is up 30%. I'd be willing to bet by the end of 2022 that those numbers are reversed. The China will have overtaken the S&P, because I do believe this initiative that they're on is difficult, and it's a hard one to do. But in terms of what the world will look like in an endemic phase in COVID, kind of this post-COVID world, they're doing a lot of things from a societal perspective that I do think sets them up to outperform. And I think investors will increasingly understand that as we go further and further into the year, when the macro backdrop, when the narrative around China is a little bit more sanguine than it is now.
Yeah, I think that's fair. And let me just add one more thing, so that there's a sort of a longer term view that's stapled onto our short term view. 2022, I think, is going to be a head fake year. Markets have very short-term memories, as we all know, and they are going to see a Chinese economy that may not stimulate like the days of old, but will look a lot more like pre-2021 in a lot of ways than 2021 did. And they're going to question whether we're going back to the status quo ante. Was this just a dip before, a 2021 dip, and then those days are over? What I would caution people is don't think 2022 is a normal year. It is an incredibly politically sensitive year. It's probably the most important year in 20 years in China from a political standpoint, maybe farther back than that, because of how important it is for what Xi's doing and for Xi breaking the traditional system of politics. So the idea here is that the trajectory you started to see in 2021 is more than likely to continue to restart in 2023. This push towards much slower growth, a slower growth narrative, et cetera. 2022 is going to have a break from some of this, because they have to get the growth numbers okay. They have to get sentiment up. Things have to look good for the party in fall 2022. But people shouldn't be head faked by this. This is not a return to the old ways. This is a break in what will otherwise be a much longer, much more precipitous trajectory down. But in the meantime, enjoy 2022, but be ready to flip gears when we get back to 2023.
Absolutely. Buy the rumor, sell the news, my friend. Well, Leland, this has been an excellent conversation. I look forward to next time we can connect, man. We appreciate everyone for tuning in. I'm Darius Dale, CEO of 42 Macro. Leland Miller, founder and CEO of China Beige Book. Check us both out on Twitter. I'm at 42 Macro D Dale. You're
at China Beige Book.
At China Beige Book, my friend. Well, appreciate you guys. Everyone have a happy holidays. Talk to you guys soon. Cheers.
Thanks.